Good evening. Please come to IFRS 11. What is IFRS 11? Joint arrangements. So, this standard deals with when two or more entities come together and they do the business together and they have a joint control over that business activity. Okay. So, the idea is now how will each parties who are the venturer or joint operators will do the accounting. Joint operator or joint venturer. Joint venture is a very common form of business nowadays. Wherever you see around you, many companies will come together to do the business. Like, for example, Tata Group and Sky. So, what is this joint venture known as? Tata Sky or Tata and AIG, insurance company. So, they have formed an insurance company, Tata AIG, right? Bharti AXA. What is the purpose of joint venture or joint arrangement? Each party can utilize their respective strength. They will bring more capital, more technology, more human resource, more marketing skills, and therefore each party is benefited. So that is the commercial logic behind joint arrangements. But we are accountants. What we will do? So first of all, we need to understand that there is a joint arrangement. If there is a joint arrangement, what is the type of joint arrangement? And after identifying what is the type of joint arrangement, then we will decide how to do the accounting. So this standard IFRS 11 prescribes accounting for all joint arrangements and establishes principle to determine the type of arrangement. Business models are getting complicated day by day. So one has to really read the fine prints carefully and then come to a conclusion whether there is a joint control, joint arrangement, what is the type of joint arrangement, and then decide the accounting principles. Point number 2, what is joint arrangement? Joint arrangement means an arrangement. So basically it's kind of agreement of which two or more parties have joint control. How many parties are required? Two minimum. You can't enter into a joint arrangement with yourself, right? You need at least two parties. And what is the maximum limit? Standard does not have any maximum limit. The limit will be defined by the law of that country. Okay, like for example in India, the Partnership Act. How many partners can be there? 50 partners. So that is an upper limit. So partnership is what is nothing but a form of joint arrangement only, but this chapter will avoid using the word partnership. It uses the word joint arrangement, but you can say joint arrangement is like partnership only. It is an arrangement of which two or more parties have joint control. So this standard has given rise to a new concept called joint control. This word control we have seen in which standard? IFRS 3 and IFRS 10. The starting point is IFRS 3. In a business combination, if there is a control acquired over a business, then we apply IFRS 3. And control is defined in IFRS 10, that is the power to direct relevant activities. Power to direct relevant activities exposure to variable return, and use of power to affect those returns. Okay. So whenever in this chapter you have to apply joint control test, first apply control test. That means the party must have control, and then two or more parties together have control, and they should arrive at unanimous decision. Then that arrangement where two or more parties have joint control and the decisions are arrived at by such parties who have joint control unanimously, then such arrangement will be called joint arrangement. Control is already defined in IFRS 10. What is joint control? Joint control means contractually agreed sharing of control of an arrangement. That means through the contract, they have decided who will have what power. That is contractually agreed sharing of control of an arrangement which exists only when decisions about the relevant activities require unanimous consent of the parties sharing the control. For this standard to be applicable, this definition must be satisfied. That means there must be a contractual arrangement. Contractual arrangement defines the control of each party. This control will exist only if you can direct the relevant activities. And relevant activities means significant activities. Like in partnership, partners have the power to affect the relevant activities, significant activities which affect return. And the decisions about relevant activities in the standard will require unanimous consent of the parties sharing the control. So there must be control. There must be contractual arrangement. There must be relevant activities, decisions relating to which is to be taken unanimously by those who have joint control. There may be a lot of people who don't have joint control. Now in this company, there are 10,000 investors. 50% share is with A, 25% is with B, and the rest of the shares are with thousands of people. So in this case, I don't require the consent of these other people. But the agreement says any decision will be taken only if 75% votes are in favor of that resolution, which means these two must act unanimously. Only then the decision will go ahead. So therefore, even this arrangement is a joint control arrangement. Okay, welcome to IFRS 11. So what is the characteristics of joint arrangement? First is there must be existence of a contract. What kind of contract? Oral or written? Contract can be oral. Contract can be written. Okay, in some cases, contract can be implied also. What is the example of implied? There are only two parties and they are holding 50% stake each. Articles of association requires 51% votes in favor of resolution. Now 50-50 means none of them can do anything, but both of them should come together to take the decisions. So therefore the parties are bound by a contractual arrangement. They have to take unanimous decision. Then they should have joint control. First there must be a contract, and second there must be a joint control. That is, contractual agreement gives at least two parties joint control of the arrangement. That means these two or more parties who have been given joint control, they must agree to a decision unanimously. Joint control means one person unanimously cannot take the decision. He needs one more person at least. And then these two persons who are required to take decision must act unanimously. What are the forms of joint arrangement? Joint arrangement can be a joint operation or a joint venture. So this standard defines two types of joint arrangement. Joint operation. In joint arrangement, usually no separate entity is created, usually. But there can be situation when there is a separate entity, but still it is a joint operation. But for joint venture, always a separate entity needs to be created. No separate entity, always joint operation. But separate entity can be a joint venture or can be a joint operation. Okay, one has to see the terms and conditions, see the facts and circumstances to take a decision. Is this understandable? No separate entity, always joint operation. But if there is a separate entity, the answer is not always joint venture. It can be joint venture, most probably, but it can be joint operation also. Now, on paragraph number 5, I have included for discussion. Just quickly, what are the terms and conditions usually included in the contractual arrangement? Not an accounting question, but a legal question. It's like, what are the terms included in a partnership deed? Same question in a different way. Terms and condition included in contractual arrangement can be the purpose, the activity, and the duration of joint arrangement. So this you have to specify that this joint arrangement is for sale of let us say wines, okay, or activity that we are into construction of bridges, or duration that this joint arrangement is for 5 years. The agreement might explain, for example, why the parties created the joint arrangement and how long they intend to operate it. Sometimes it can be only for a particular activity, like construction of bridges, dams. Once that activity is over, the agreement dissolves. It would establish who the parties creating the joint arrangement are, which parties exercise joint control, and which parties do not have joint control. And then next thing, they will include how the members of the board of directors or equivalent governing body of the joint arrangement are appointed. Third, the agreement could establish how the parties nominate members onto the board, what their responsibilities are, and how the board of directors are or can be removed. It would also establish the voting rights of each board member. And then there is a note on decision making process, how the decisions will be arrived at. This establishes the existence of joint control via decision making process. It could include details on what activities would qualify as relevant activities. And these activities require unanimous consent by the parties exercising the joint control. So in the agreement, they can make a list of the relevant activities and they will mention this would require unanimous consent. Then capital or other contribution required. How the parties will share asset, liability, revenue, expense or profit or losses arising from joint arrangement. and I have written a comment also, that this is one of the key factors in establishing whether it is a joint operation or a joint venture. If the asset, liabilities, revenue, expenses are shared separately, then it is likely to be a joint operation. But if only the net assets are separate or shared, net profit is shared, then it is more likely to be a joint venture. So when individual asset, liability, revenue, expenses can be shared, likelihood is that it is a joint operation. And when net asset or net profits are shared, there is a high probability that it is a joint venture. And then the agreement may include delegation of entities day-to-day operation to one of the parties to the joint arrangement, and transfer of interest to new parties or among existing parties. That is, whether you will add new members, transfer of existing interest to other parties, etc. And the last one I have written, arbitration procedure, which become particularly important when the parties cannot reach the unanimous agreement. This paragraph may not be very important for exam, but it gives you a highlight of how joint arrangements are negotiated or entered into. Now I am going to discuss an important paragraph for answering many questions that they will ask you. Because your application of standard depends on identifying first that there is a joint control, and then whether this will give rise to joint operation or joint venture. Because if it is joint operation, this standard is applicable. If it is joint venture, then IS 28 will become applicable for further accounting. So now I have written a long paragraph on how do we assess joint control. So first what we'll do, we'll go to IFRS 10. See the definition of control and see which parties have control. So the IFRS 10 defines control and shall be used to determine whether all the parties or a group of parties are exposed to or have rights to variable return from their involvement with the arrangement and have the ability to affect those returns through their power over the arrangement. So first we need to find out who are the parties who have the control. Okay, that means who are the parties who have the rights, variable return, ability to affect those returns. When all the parties or a group of parties considered collectively, underline, I think I have done it for you, considered collectively are able to direct the activities significantly affecting the returns of the arrangement, then the parties control the arrangement collectively. So all those parties who have the control, they must come together only then the decisions relating to significant activities can be taken. Then the arrangement is joint arrangement. Okay. Parties may have control, but unless all the parties who have control come together and take unanimous decision, the decisions cannot be taken. It is not a joint arrangement. IFRS 10 defines control. I think this is a repetition. Okay. Next line below that. When all the parties or a group of parties considered collectively are able to direct the relevant activities that significantly affect the return of the arrangement, the parties control the arrangement collectively. So what are the requirements to assess joint control? Parties should have control. Parties should come together unanimously to take the decisions relating to collective activity. It is not necessary that there must be 100% people who should vote in favor of the resolution. Those who have the joint control should agree unanimously. And it is possible the joint control may be with people holding 75% of the voting rights. They must agree. Joint control may be with people holding 51% voting right. Then they must agree. Then in that case, it is a joint arrangement. Because practically there are large number of shareholders who are just passive shareholders, so they don't have any control. Assessing whether the arrangement is jointly controlled by all of the parties or by a group of parties or controlled by one of the parties alone can require judgment. Is it right? Now see, there is a small flow chart for understanding which standard is applicable. Whether this standard is applicable or not. Does the contractual arrangement give all the parties or a group of parties control of the arrangements collectively? If the answer is no, outside the scope of IFRS 10, 11. If the answer is yes, do decisions about the relevant activities require the unanimous consent of the parties or a group of parties that collectively control the arrangement? If the answer is no, again outside the scope of IFRS 10. So there must be joint control, there must be unanimous decision. If the answer is yes, the arrangement is jointly controlled and the arrangement is a joint arrangement. Now case 1. Sometimes the decision making process that is agreed upon by the parties in their contractual arrangement implicitly leads to joint control. Implicitly means they may not specifically mention it in the contract. Like for example, this example 1 will give you an idea about implicit joint control. They have not specifically agreed, but the way they have designed the agreement, it would amount to they must agree unanimously. Two parties, A and B, establish an arrangement in which each has 50% of the voting rights, and the contractual arrangement between them specifies that at least 51% of the voting rights are required to make decisions about the relevant activities. Each of them hold 50%. What the contractual arrangement says? 51% votes in favor of the decision. But how will 51% votes be passed? Both of them has to agree. Only one person has 50%. So indirectly, this arrangement is nothing but it wants that parties must agree unanimously. Although not specifically mentioned about unanimous decision making for relevant activities, does joint control exist in this case? Yes. No. Yes. Right, 2-3 lines. In this case, now write down, in this case, your answer is yes, even though it is not specifically mentioned, but the contract has been designed in such a manner that there is no way but both parties need to agree, only then the decision can be taken. So there has to be unanimous consent of both the parties. In this case, the parties have implicitly agreed that they have joint control of the arrangement. Implicitly agreed that they have joint control of the arrangement because decisions about the relevant activities cannot be made without both parties agreeing. So that is joint control. So there exists joint control. One more example we'll take of implicit joint control. X and Y form a new joint arrangement, JA Limited. Article of Association of JA Limited includes a clause that states that all shareholders must unanimously agree on the relevant activities of the entity. Now, here they have not mentioned anything in their agreement, but it is the article of association, that is the charter of the company. Okay, rules and regulations for internal management. There is a clause included that all shareholders must unanimously agree on the relevant activities of the entity. No other agreement is entered into by the shareholders to manage the activities of JA Limited. Now, here there is no specific contractual arrangement, but AOA mentions about unanimous agreement. Should the arrangement satisfy contractual arrangement test of IFRS 10 to define the arrangement as a joint arrangement? Yes, but there is no contract. AOA is binding. So there is an implicit arrangement. So as I told you, there can be oral agreement, written agreement, but in some cases there can be implicit arrangement. So these two examples, 1 and 2, are the examples of implicit arrangement. Although there is no separate contractual arrangement, JA Limited does meet the definition of a joint arrangement. Is it right? Does meet the definition of a joint arrangement. The clause included in AOA of JA Limited, the clause included in AOA of JA Limited is sufficient for the definition of a joint arrangement to be met as per IFRS 11. This is an example of implicit arrangement. Write down concluding line. It is assumed that AOA of JA Limited is in order as per the Companies Act and are legally binding. Okay. Case 2. So the case 1 I have discussed when you can have an implicit joint control, and now case 2, in other circumstances the contractual agreement requires a minimum proportion of the voting rights to make decisions about the relevant activities. Now here also one has to see how the arrangement will be made. Suppose the agreement says at least 75% of the votes should be casted in favor of resolution. A, B, C are stakeholders. 50, 30, 20. Now which means A and B has to agree unanimously. Then only the decisions can be taken. And if A and B have the control over the relevant activities and the terms of the joint agreement provide that A and B must agree unanimously, then in this case this will become a joint arrangement, right? So when that minimum required proportion of voting rights can be achieved by more than one combination. Now I'll make one small change in the example. Agreement says 75% of the votes should be in favor of resolution. Now what are the combo possible for achieving 75%, A plus B, A plus C. When the minimum required proportion of voting rights can be achieved by more than one combination of parties agreeing together, that arrangement is not a joint arrangement unless the contractual agreement specifies which parties or combination of parties are required to agree unanimously to decisions about the relevant activities of the arrangement. Then if the agreement says A plus B must agree unanimously, it will become contractual arrangement. A plus C must agree unanimously, then also it will become a contractual arrangement. If the arrangement is silent, then it is not a joint arrangement. So now you see on this line there is a question at the end. Go to question number 3. It is there only. Question number 3. An arrangement has 3 parties. The same point explained with the help of numbers. Om 50%, J Jagdish 25% each. Om Jai Jagdish. Okay. 50, 25, 25. Contractual arrangement between Om J Jagdish specifies that at least 75% of the voting rights are required to make decisions about the relevant activities of the arrangement. Now there are 2 combinations possible to achieve that 75%. Discuss the different combination of joint control that can affect the decision making of the relevant activities of the joint arrangement. So what are the different combinations that can help us to achieve the decision making? Om and Jai, Om and Jagdish. But whether this will be a joint arrangement or not, that depends on the agreement. So how will you write the answer in the exam? Om can block any decision. It does not control arrangement because it needs agreement of either J or Jagdish. Om, Jai and Jagdish collectively control the arrangement. However, there is one more combination of parties that can agree to reach 75% of the voting rights, either Om and Jai or Om and Jagdish. Now, in such a situation, to be a joint arrangement, to be called as a joint arrangement, the contractual arrangement between the parties would need to specify which combination of parties is required to agree unanimously. So if the contract says Om and J should agree unanimously, then this will become a joint arrangement to decisions about the relevant activities of the arrangement. Now in the last 2 pages what we have learned, what is joint arrangement, what is joint control, when will this standard be applicable. Now assuming that we have passed all those tests, there is a control, there is a joint control, there is a contractual arrangement, there is a unanimous consent. Now the next task is, what is the type of this joint arrangement? Okay, so the standard says all joint arrangements will be broken into 2 categories, divided into 2 types only. Okay, joint operation and joint venture. Just for general knowledge, Accounting Standard 27 issued by Institute of Chartered Accountant of India has 3 categories of joint venture: jointly controlled operation, jointly controlled asset, jointly controlled entities. These 2 are like joint operation and this is like joint venture. But again, this standard is different from the Accounting Standard 27 issued by ICAI. So one has to be careful. Now first I will just, for general knowledge, practical example of some ongoing joint ventures. Example of joint venture: Larsen and Toubro, an Indian company, and Shanghai Urban Construction Group. They are involved in design and construction of tunnel for Delhi MRTS project. And then Larsen and Toubro and Shapurji Palanji and Company. They are involved in design and build work for construction of TCS SEZ Kolkata. ठीक है? And then the example of joint operation, where they have come together to execute an operation where normally separate entities are not created. L&T and Sojitz Corporation, they are involved in design and construction of special bridge across Narmada River. And L&T and Galfar Consortium, they are now involved in construction of the Salala Airport project. Right? You will also bring 4 examples on Monday. No. For example of each joint venture and joint operation. Now, dear student, we'll discuss one more practical example. Entity C and entity D operates in a telecommunication industry. Question number 17. And entered into a joint arrangement in order to combine their 4G access network. So again, this is a quite common arrangement in telecom business. Okay. The purpose of this arrangement is to reduce operating costs for both parties, make capital infrastructure saving, and obtain economies of scale from jointly managing and maintaining a consolidated network. So this will have a huge saving for both the parties. All significant decisions about strategic investing and financing activities are decided by a simple majority of the voting rights. So you require a simple majority. But see the problem. Entities C and D each have one vote in the decision making process. So how will you achieve majority? Both should agree. If both should agree, that means the decisions will require unanimous consent. Whether such arrangement will be called joint arrangement? The answer is yes. Don't write the answer printed. All decisions about the relevant activities require consent of both the parties, so the arrangement is a joint arrangement. The contractual arrangement does not explicitly require unanimous consent, but the fact that all decisions must be made by majority leads to an implicit joint control. Okay, now solve this question. It is just below that 18 number. NFG Limited is owned by numerous shareholders with the following holdings. Shareholder N owns 51%, F owns 30%, rest all 19%. NFG Limited's AOA requires a 75% majority to approve decisions about any of the entity's relevant activities. They also outline that each shareholder is entitled to vote in proportion to its respective ownership interest. Is NFG Limited jointly controlled? Is it jointly controlled? Why yes? NNF collectively own 81. So they must come together. And the agreement must outline that N plus F are required to vote unanimously. Then only it will be treated as a jointly controlled arrangement. So NFG Limited is jointly controlled by shareholders N and F based on their ownership interests, collectively 81%. They must act together to make decisions regarding NFG Limited's relevant activity. Shareholder N does not control NFG Limited as it cannot unilaterally make decisions because a 75% majority is required. So they have to come together for any relevant decisions to be taken. Can I give you one homework now? 19 number, note down homework. 19. And one more question number. These are all important questions. They can ask you in any form. Question number 9. 9 also note down homework. So 2 questions I have given. You will read, think about the solution, and then compare your solution with the ICAI solution given, institute solution given. Now come to types of joint arrangement. Joint arrangement can be joint operation or joint venture. So this is a small summary of 2 types of joint arrangement. Common feature in both type of joint arrangement is that there must be a contractual arrangement or implicit contractual arrangement, and there must be joint control. When you are practically evaluating a joint arrangement, one has to see the structure of the joint arrangement, how it is created. If it is created through a separate vehicle, most probably it will be a joint venture. And if there is no separate vehicle, it is always a joint operation. And then if it is a separate vehicle, one has to also read the terms and condition. If the parties are entitled to asset, liabilities, income, expense, output separately, then joint operation. If the parties are entitled to net asset or net profit, then it is a joint venture. And in addition to that, one has to also check the relevant other facts and circumstances. So now paragraph number 8, joint operation features. First is, these are not structured through a separate vehicle. The moment you find a question where it is not created, not through a separate legal entity, that separate entity can be a partnership, limited company, listed company, unlisted company, LLP, or whatever. It should not be a separate entity. Each party will operate from their own premise only. Only they will execute the work jointly. Okay. Parties that have joint control of the arrangement have rights to assets and obligation for the liabilities relating to the arrangement. Second feature of joint operation is that sometimes there may be a separate legal entity, then apply this feature. Parties to the joint control, parties who have joint control, they have rights to assets separately, liabilities separately, and they have a right to corresponding revenue and obligation for corresponding expenses. This is the second feature. And this will help you to identify a joint operation. Even if it is a separate entity, but suppose the agreement says X Limited will get land, building, plant, Y will get stock, debtor, cash, X Limited will take secured loan, Y will take unsecured loan. What is the arrangement? Joint operation. Or they will say output will be taken by A and B in the ratio of 50-50. Then also joint operation. So if they share the output separately, expense separately, then such features will lead us to joint operation. Then the parties to joint operation who have joint control, parties to joint operation plus they must have joint control, they are called joint operators. And then the standard will become applicable to joint operators. One example I have given below, it is an example, not a question, how joint operations work practically. Gas pipeline connects 2 points between Mumbai and Pune by a distance of about 150 km. Gas pipeline is owned jointly along with equipment by 2 companies, X and Y. The joint operation states that the maintenance of the oil pipeline will also be shared on equal basis by 2 parties. Each party will recognize his share in pipeline in SOFP and include his share in expense in the statement of profit and loss. This kind of joint arrangement is a joint operation, right? One more example we'll take. Go to the list of questions at the end. Search for this question. 7. There is an arrangement in which Ram and Shyam have 35% of voting rights and remaining 30% widely dispersed. Decisions about the relevant activities require approval by a majority of the voting rights. Do Ram Limited and Shyam Limited have joint control over the arrangement? If the arrangement specifies, okay, because individually they don't control, they need the support of the other to take the decisions relating to relevant activities. So if the agreement specifies Ram and Shyam must act together unanimously, then this agreement or arrangement will be called a joint control, and this standard becomes applicable to Ram and Shyam. So how will you write the answer? Ram, Shyam have joint control of the arrangement only if the contractual arrangement specifies that decisions about relevant activities of arrangement require Ram and Shyam agreeing. Okay. Next question number 8. Below that, Hari and Ram enter into a contractual arrangement to buy a 2-storied music store. Okay, can you see 2-storied music store? 1, 2, which they will lease to other parties. Hari will be responsible for leasing the first floor. This is Hari's floor. Ram will be responsible for leasing second floor. They can make all decisions relating to their respective floors and keep all of the income with respect to their floors. Whether first floor and second floor will come under joint control? No, because they don't require the decision support of other parties for any decisions relating to first and second floor. But the ground floor will be jointly managed. All decisions and will with respect to ground floor must be unanimously agreed between Hari and Ram. Discuss the applicability of IFRS 11. So for such question, bonus mark. First floor that Hari controls will not be accounted under IFRS 11. There is no joint control. Second floor Ram controls will not be accounted under IFRS 11. And the ground floor that Ram and Hari and Ram jointly control is a joint arrangement within the scope of IFRS 11. Now we will take a break.